more belt-cutting measures from another bank.
Exactly, Sherry. I mean, the stock is down 29% this year. Compare that to the KBW Bank Index, which is down 20%. It's down more than that, and we'll get to some reasons why. But we don't yet know the extent of these job cuts. The filing didn't say. It left it very open, but it's also reducing its corporate headquarters footprint, its real estate footprint.
All right, we have more changes unfolding in the U.S. economy and the U.S. banking system. Changes that just saw 5 more banks have their credit ratings cut yesterday by Standard & Poor's. That's after the Moody's downgrades last week. But there's one bank amongst them all that takes the cake, a bank so unique and vulnerable in this high-rate environment. It stands out like a sore thumb, as there's been these whispers and rumors circulating for months. Well, they quietly announced a massive restructuring effort yesterday, massive layoffs and other consolidation in an effort to shore up funds. We're going to explain what's happening here, because the risk to the broader banking sector, should this bank fail, is now top of mind. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So let's just start with rates, because it ties into the banks and to the story in general. They are rising, climbing, folks. The 10-year now at 4.35%, highest since 2008. The 30-year fixed at 7.5%. Look, we've been warning about this for months, how rates will continue to move higher, how they had to continue to move higher, especially mortgage rates, right? As demand for mortgage-backed securities are so low, so pitifully low right now, been this low for months, but this past week has just taken it to like a whole new level, folks. And what happens when lenders don't have investors to buy your mortgage? They charge the next home buyer more, increasing the next home buyer's rate in an attempt to make these MBS more attractive, more enticing for possible investors. That's what raises interest rates. It's all about supply and demand in the bond market. We are seeing it play out right now in the mortgage market and the treasury market, which we've also talked a lot about in previous videos, how the government juicing the size of their auctions, looking to borrow upwards of $1 trillion this month and next month as well, will cause rates to spike. We said it when the Treasury released that borrowing plan last month. There's just too little demand right now. I have no idea what they're thinking. Either they don't understand the consequences, or they don't care, or they want this to happen, or a combination of all the above. So here's the thing. Interest rates are the predominant factor when it comes to asset prices. It's like a universal law. Low interest rates equal higher asset prices. High interest rates equal lower asset prices, which is exactly what has the market spooked, and the banking sector in particular. As the lower bank stocks go, the more liquid these banks technically need to be. We could see it clear as a bell right here. One thing you learn to watch when investing are asset flows, where the big money is moving. Well, last week it moved the hell out of risk assets like stocks and into cash. We spoke about this last video, showing how more money had moved into cash year to date so far than all of last year. It's actually an all-time record, but it also means it's pulled out of bank deposits and moved to money market funds, sucking away the little liquidity that banks have left. This is the type of movement that leads to what we saw in March with the banking crisis, as there's rules that need to be followed with regard to how liquid a bank is, but the more urgent need for them is ensuring they have the cash available to facilitate their client withdrawals. Well, enter Charles Schwab, a kingmaker, a name that may not be super familiar to everyone, but really is one of the most important U.S. financial institutions, and not for the same reason as a JP Morgan, where they're just too goddamn big to fail, but instead because who they have as clientele. Lots of wealthy customers park their money there, as they have that brokerage side of their business. If you have, let's say, over 10 million cash, you likely have some of your money invested through Schwab. Now, following the banking turmoil back in March, there were these rumors that started floating around that they were underwater, which was odd considering that Schwab would be like one of the last banks that you'd expect to fail. They aren't like an SVB doing venture capital work. They don't mess around with crypto like Signature Bank was. They are, for all intents and purposes, one of the strongest, well-established U.S. bank brands. But despite that, the rumors continued, probably coming from insiders, and it got bad enough that their CEO had to go on CNBC and try to shore up confidence. Here's part of the interview. Take a listen to this.
Thank you for joining me. I know you don't speak out very often, but we're going through some pretty extraordinary times in your world right now. Thank you.
Yes, and thanks for the invitation. I actually learned last night about 10 p.m. that your network had emailed a staffer in our organization about me coming on yesterday. And unfortunately, as I mentioned, I didn't realize that till last evening. Of course, I've been on many, many times with you before. And so I just want to apologize for that. If I would have known, I likely would have been on.
We're happy to have you today. And we have to address what's happened with your stock first and foremost. It's not necessarily the first place you think about for contagion after a collapse of a bank in Silicon Valley that did a lot of lending to venture capital firms, but that's what's happened. Your stock is down almost 30% over the past week, including today's bounce. Why?
Well, I think there's been a degree of confusion on two sides of our firm. The first one is the difference between a brokerage operation and a banking operation.
So following that segment and their CEO announcing that he bought 50,000 shares of their stock trying to impress confidence amongst his shareholders, well, it seemed to work. The pressure had come off, time went on, and financial media stopped pressing the topic, stopped asking questions, but those rumors and whispers continued, all boiling over yesterday with a massive restructuring plan. Take a look at this Bloomberg article published yesterday. And again, financial media doesn't want to cover this one. Charles Schwab isn't just any other bank, as most reporters all the way up to top brass probably have money at Schwab, or their families likely have money at Schwab. All right, take a listen to this. The title of this piece is Schwab to cut staff in real estate to save $500 million a year. They write, Charles Schwab is planning to cut jobs and close or downsize offices to achieve at least $500 million in annual cost savings as the brokerage responds to investor pressure. And before we keep going with this, let me just read you a part of a note from a few months ago that will shed some light on what's really happening here, because this is the first step to a bigger problem, folks. And remember, however bad it looks from a company's press statement, it's always much, much worse behind the scenes. This will sum up in 30 seconds why they're being lumped in right now with SVB and Signature Bank. Here's what Bloomberg writes. Schwab's $7 trillion empire built on low rates is showing cracks. They write, Schwab is unusual among peers. It operates one of the largest U.S. banks grafted onto the biggest publicly traded brokerage. Both divisions are sensitive to interest rate fluctuations. Like SVB, Schwab gobbled up longer dated bonds at low yields in 2020 and 2021. That meant paper losses mounted in a short period as the Fed began boosting rates to stamp out inflation. 3 years ago, Schwab's main bank had no unrealized losses on long-term debt that it planned to hold until maturity. It then shifted $189 billion of agency mortgage-backed securities from available for sale, which means that they could have sold them at any time that they wanted, to held to maturity on its balance sheet last year, a move that effectively shields those unrealized losses from impacting stockholder equity. Okay, Houston, we have a problem here. So roughly $200 billion of customer deposits are now locked into long-term mortgages that they can't sell in the case of an emergency, like a bank run, meaning they are $189 billion less liquid. And wait for this. This is the kicker, all right? Listen to how badly they screwed themselves. Here's what Bloomberg writes. The rules governing such balance sheet moves are stringent. It means Schwab plans to hold more than $150 billion worth of debt to maturity with a weighted average yield of 1.74%. So get this, thinking they were getting ahead of the Fed, thinking the Fed was going to hike rates last year, which they were right about, they made this balance sheet change to protect their equity. But by doing so, they locked up $189 billion of customer deposits at a rate of, wait for this, 1.74%. 1.7%, folks. Where are we right now with the 30-year mortgage rate? It's like 7.5%, but they're only earning 1.7 on their MBS. And here's the kicker. This decision that they made is losing them money, lots and lots of money, as they no longer have the flexibility to offer more yield to customers, as they're only earning 1.7% return on close to $200 billion for the next decade or two. A real bonehead mistake. And this all comes full circle now, as their customers don't want to leave their money sitting in their Schwab account earning no interest. Now let's jump back over to yesterday's report. Bloomberg writes this: Schwab said earlier this month that it's experiencing temporary lower net flows of client money as the brokerage sees attrition of some retail and advisory client assets while it integrates TD Ameritrade into its business. They say they're seeing attrition, meaning a loss of clients. Look, bottom line, if Schwab was to fail, that would be bad. Obviously bad for the 7 million plus customers that they have, but also because the Fed would probably see them as too big to fail, too big to not intervene, and we don't want the Fed intervening. We want them to stay out. The more they interfere, the more bailouts they conduct, the longer all of this lasts. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.